Okay, we have a question here. It says three companies have the following results during the recent period: net profit margin, total asset turnover, assets over equity. Derive for each company the return on equity. So, before we derive this return on equity, we need to understand what these terms mean. Okay, we can start net profit margin. Those who are there in the class for financial ratios. What is the net profit margin? What is the net profit margin? So I'll send you this document after this class where there are all these notes and everything. These notes are for you to read and everything. But yes, net profit margin. What is the net profit margin? Because when you are making a portfolio, you are going to and you're deciding which companies to invest in. This is one metric you might be interested to look at, the net profit margin of the company. So what does net profit margin tell us? Yes, try, madam. Madam, well, I'm waiting on you. No, no, I was saying that net profit margin, what does it tell us? Was that what you were trying to explain when you raised your hand? Or maybe it was something. Oh, you can go ahead, madam. Yes, the net profit compared to the sales revenue. It tells us what percent of sales revenue is net profit. Okay. Or for every one quarter you make in sales, how much net profit you get. Okay, colleagues? Yes. Then this one, the total assets over equity is known as the equity multiplier. Okay. Tells us how much of a company's assets are funded by equity or the owner's money. Okay. One way you can think of it is for every one quarter of equity, how much do we have in assets? Okay. That's how you can interpret the equity multiplier. Okay. Then asset turnover tells you how much sales revenue a company earns for every one quarter invested in assets. Okay. When you invest in an asset, how much sales revenue you're getting. Because those assets you're investing in, to help your business earn more sales, and to help run a business so that business can expand or the business can operate smoothly to make sales. Okay. Then we have now a return on equity. All right. Which is telling us for every quarter of equity invested by the shareholders, how much profit the company produced. Okay. So for every one quarter that has been invested in equity, how much profit has been produced. Okay. Yes. So when you have been given the net profit margin, the asset turnover, and the equity multiplier, that's how you get your return on equity. Okay, that's multiplying net profit margin, asset turnover, and the equity multiplier. Okay. So for company K, net profit margin 0.04. Asset turnover, so we interpret this. So for company K, since their net profit margin is 0.04, so it's telling us for every one quarter they invested, or for every one quarter they make in sales, they're making four ngwe is net profit. Okay. For every one quarter in sales, four ngwe is net profit. For company L, for every one quarter they make in sales, six ngwe is net profit. For company M, for every one quarter they make in sales, 10 ngwe is net profit. So as a portfolio manager, or someone who's making portfolios for people, amongst these three, if you're deciding based on the net profit margin, which one would you get? Company L. What about company M? Company M, for every one quarter they make in sales, 10 ngwe is net profit. Company M is doing better in terms of net profit margin. We're looking at net profit margin, madam. Okay. I was first I'm basing this on net profit margin. Then we'll base it on asset 10 years. Well, I want to base it in all these metrics, okay, so that we gain an understanding, okay. But as if in terms of return on equity, yes, company L is the one that is doing better, okay. For every one quarter that is invested in equity, company makes 26 ngwe in profit. Since this 26.4, if you divide it by 100, it's 0.264. Yes, for every one quarter invested in equity, the company makes 26 in coin profit. Okay. For K, for every one quarter of equity that is invested, company makes 21 in coin profit. Okay. Even company M, for every one quarter of equity invested, company makes 21 in coin in profit. So if we are basing it on return on equity, madam, yes, L is the one that's doing better. Okay. Yes. Okay. If it's asset turnover, if we look at company K, okay, for every one quarter invested in the assets, the company makes two quarter Tungwe in sales revenue. Okay, because the asset turnover, how much sales a company earns for every one kwacha invested. So for L, for every one kwacha invested, okay, it's making 2 kwacha in sales revenue. For every one kwacha invested in the assets, L is making 2 kwacha in revenue. Okay. For M, for every one kwacha invested in assets, it's making one kwacha 14 in sales revenue. So in terms of asset turnover, K is utilizing its assets more efficiently because it's generating more sales from its assets. Okay. Asset turnover is basically generating sales from the assets you've invested in. Okay. Return on equity, generating profit on the equity that has been invested. Okay. Yes. So as I said, for the return on equity here, just know if you see this question here, you're just multiplying all these values 0.04, 2.2 times 2.4, 0.06 times 2 times 2.2, and 0.1 times 1.4 times 1.5. That's how you get your return on equity. Any questions before we go to the part B, which says given the oh yeah, any questions before I read part B? Okay. Given the following earnings and dividends, compute the sustainable growth rate for each firm. Earnings per share, dividends per share. Colleagues, what is earnings per share and what is dividends per share? Colleagues, how will people trust you with money to make portfolios for them? Yes. What what do we understand by earnings per share and dividends per share? Okay, please go ahead. I was cut off. I think let's see. Yeah, this was just a slight network mishap. Yes, whoever wanted to try, please go ahead. Hmm. Okay, what you could do is, I'm asking, what does it tell us? What you've said there needs some corrections, but um, what does it tell us? Rebel by whom? Mhm. Okay, basically, what it tells us is this: from the net profit that has been generated from the the company, it tells us how much each shareholder can get from the net profit. How much each shareholder can get from the net profit. Okay, in simple terms, how much each shareholder can get from the net profit. Okay. Although we all know that when a company establishes its net profit, not all of that net profit is going to go to dividends. Some of that profit can be kept and people don't get paid dividends. That's what the earnings per share says. The net profit that can be allocated to each dividend holder. Then dividends per share. Here you get now the dividends, the amount allocated for dividends from the company's profit, the amount for the dividends divided by the number of shares. Just saying you how much dividends each shareholder is getting. Okay. Then we've got this sustainable growth rate. What does it tell us? The rate at which each company can grow with their profits. Okay. If the company is utilizing its profits, at what rate can it grow? Okay. So this is a very important metric for you holding a portfolio. The only thing that in real life, these things, as I said, they're theoretical. Okay, these financial ratios, majority of them are theoretical. Okay, like asset turnover. It doesn't mean that yes, your sales is the sales actually coming from the assets you invest in. That's just an estimation. Okay. And even this sustainable growth rate, you can get maybe one company can have a good ratio, but then you find the next year there's a company scandal, something happens, find the company now is in losses and you've already invested in it. So this game is a very tricky game. Okay. These ratios, they're just forecasts. Okay. It's not that in reality it's what's happening. Okay. But they give you an idea of how the companies are operating also. So I won't say that they are useless. No, it's just giving you ideas, but think of this more as theoretical. Okay. Doesn't mean if a ratio is good, it means even the next years the company will be doing the same. No, things change. The business world is dynamic. Okay, so when you're investing people's money, you need to be very, very careful. Yes. Okay, so the sustainable growth rate is the retention ratio times the return on equity. Okay. Retention ratio, how much profit the company is saving to reinvest for growth rather than sharing with the shareholders. How much you are keeping, which you could have given the shareholders, but you have decided to keep it because you want to reinvest in your company. in growth of the company. So the retention ratio is 1 minus the dividend per share over earnings per share. Okay, so did I calculate? No. Okay, so here we need to calculate the retention ratio of each firm. So company K, see here. Okay, so company K, the retention ratio, let's see. So it's the dividends per share. Yeah, dividends per share over earnings per share. So let's tabulate. We see which company is withholding money for the shareholders to invest in the growth. 1 minus dividend per share, DS, over earnings per share. So for K, you say 1.25 divided by 1.75. What do we get? 1.25 dividends per share divided by earnings per share, 2.75. 0.45. 1 minus 0.45. 0.545. Or we can just put it at 0.55. Okay. Company L, dividend per share 1 divided by earnings per share 3. So it's a 1 minus 1 over 3. I think 1 over 3 is 0.33. 0.77. And these guys are holding more money, withholding more money to invest in growth than give to their shareholders compared to L. Oh, 6.7, huh? Then company M 1 minus 1 over 4.5. After you have done all the tabulations, colleagues, are we all getting 0.333? 0 points. I want two decimal places. Two decimal places. 0.77. Okay, so we can see M is withholding more money than the others. Okay, so let's say, for example, you are trying to form a portfolio and you see this. Which company will you invest in? Or which company will you buy shares in? Looking at the retention ratios. Here we're basing it on retention ratio. Retention ratio, as it means to retain, meaning you're retaining your profits, okay, so that you can use it for growth purposes instead of giving your shareholders. So, wh- which one would you likely buy shares in? Yeah, because it's retaining less. Yes, that's a good point. Yes, the one who is retaining less as the theoretically looks like the one who would pay out dividends and even pay out maybe more dividends since they've been retaining less. Okay, but I think that one should be looked at on a short-term basis. On a long term, the companies that are keeping the money to grow, when they grow, we can expect higher dividends and increase in our share prices, the share prices of the stocks. And you as a shareholder, when the share prices increase, you can sell them so that you will also make a profit from that. So it's more of Mhm. Yes, that can be okay. Yes. So once we've got these retention ratios, now we multiply it by the return on equity. Okay. So company K 0.21, company L 0.26, this one 0.212, then this one 0.21. So company K 0.55 times 0.212, company L 0.67 times 0.26, then company M 0.77 times 0.21. Yes. Yes, 0.55 times 2.12 SGR is the retention ratio times return on equity. So we got our retention ratios already. So for K, it's 0.55. Its return on equity 0.212. Colleagues, none of you came with calculators? Madam Patricia, 0.1155. 0.1742. 0.16. Okay, so remember, the sustainable growth rate is the rate at which a company is expected to grow using its own profits. So company K is expected to grow at 11.5% using its own profits. Company L is expected to grow at a rate of 17%. Okay. So we can, and then also company M is expected to grow at a rate of 16%. Uh-huh. Come again? Or I said the first things first, we got the retention ratios. Then we now got the return on equities for each company. So, so remember return on equity, L return on equity, and M return on equity. Yes, these ones from part B, part A. Yes. So company L is expected to grow at a higher rate with its own profits than M and K. Okay. So if you're an opportunistic investor, you'd be inclined to invest in company L. Mhm. But as I said, in reality, you might find the next year and the previous year, you find company K is actually growing at a higher rate than the other one. Or another company M is the one growing at a higher rate. Okay, so these it doesn't mean they are set in stone once you find them. Things can change.